Okay, so there is a massive fundamental shift happening in the financial world as we speak. We're talking about a super high-stakes race with trillions of dollars on the line to basically rebuild the entire plumbing of the stock market. This, right here, is the race to tokenize everything.
And if you want a sense of just how big this is, just look at this quote from Coinbase CEO Brian Armstrong. Let that sink in for a second. A tiny 3% slice of the regular old stock market would literally double the size of the entire crypto market. The scale of this opportunity is, well, it's just mind-boggling.
And that, right there, is why everybody is scrambling to get a piece of this. You've got the crypto natives like Coinbase and Kraken, and you've got the mainstream giants like Robinhood. This isn't some far-off theoretical thing. It's happening now. They're already rolling things out in Europe. The race is on, and the competition is absolutely fierce. Which of course brings us to the real question. What are we actually talking about here? When someone says tokenized stocks, what are these companies building? And more importantly, if you buy one, what do you really truly own? All right, so let's get into it. To really get what this race is all about, you have to understand the cars they're driving. So what in the world is a tokenized stock? And why are the current versions kicking up so much dust? So at its heart, the idea of tokenization is actually pretty straightforward. You take a real-world thing, like a share of Tesla stock, and you create a digital version of it, a token, that can live and be traded on a blockchain. People love this idea, right? I mean, 24/7 trading, more access for more people, it sounds amazing. But, and this is a big but, there's a catch.
You know, we all kind of assume that a tokenized stock is a perfect digital copy of the real thing, like an identical twin. But that's not really true for most of the models out there today. It's much more accurate to think of them as fraternal twins. They might look alike on the surface, but underneath, there are some really crucial differences.
And here is that crucial difference. When you own a normal share of stock, you get a direct title. You own it. You get to vote. With a lot of these new tokenized versions, though, you just get a digital representation. You often have no direct claim on that share, no voting rights. So in the way we all think about ownership, you don't actually own it. So this brings us to the different teams in this race and the playbooks they're using. Because, and this is key, not all tokenization is created equal. Right now, the market is split between a couple of different approaches, and, well, frankly, they all have some pretty big flaws. So on one side, you have the wrapper model. This is what firms like Robinhood have used. Think of it like a synthetic IOU. It tracks the price of the stock, but it's not the stock. And you're usually stuck trading it inside that one company's world. Then you've got the SPV-backed model, which Kraken uses. This gets a bit closer. A separate entity holds the shares, but the token you own just gives you a right to the cash value of the stock, not the stock itself. It's better, but it's still not real ownership.
When you lay it all out like this in a table, the problems just jump right out at you. Take a look at the ownership and governance rows for those first two models. You see synthetic exposure and no, that's the issue. But then, look over at that third column, the depository receipt model. It says it preserves shareholder rights, it's fully fungible, and it allows governance. We're gonna come back to that one.
Right, so a race this big doesn't happen without a referee. And in the world of finance, that referee is, of course, the SEC. So with all this newfangled tech flying around, what do the regulators have to say? This quote from SEC Commissioner Hester Peirce, who you might know as Crypto Mom, is super telling. It seems the SEC's position, or at least her view, isn't to step in and pick a winner right away. It's more of a let's wait and see approach. They want to let the market experiment and figure out which model actually works best for investors. But wait and see does not mean it's the Wild West. The SEC is being very clear about a few things. First, all the old securities laws, they still apply. And number two, disclosure is everything. Companies have to tell you exactly what you're buying. Are you buying the real thing or just a derivative that looks like it? And you know, not everyone is sold on this. You've got giants like Citadel Securities voicing concerns that some companies could use the confusion to get around the rules.
So, if the current models are kind of broken and the regulators are watching like hawks, where does that leave us? Where's the solution? Well, what's really interesting is that the answer might not be some crazy new invention. It might be a playbook that's been working perfectly for more than 100 years.
And here it is, the depository receipt, or DR. Now, a lot of you have probably heard of American depository receipts, ADRs. It's how investors in the US have been able to buy and trade shares in foreign companies like Sony or Toyota for ages. It's a time-tested, legally solid system. You could almost say it's the original analog version of tokenization.
So how would it work in the digital world? Well, it's actually pretty elegant. Step 1. The real physical shares are locked away for safekeeping with a regulated bank. Step 2. A totally separate, neutral company issues a digital claim check, that's the token, for each share. Step 3. That token, that digital claim check, can then be traded freely on the blockchain. And here is the magic part. Step 4. Because you hold the official receipt, all the rights of the shareholder, like getting dividends and voting, get passed directly to you.
So what this all means is that the depository receipt model isn't some flimsy IOU. It's not a complicated derivative that's hard to understand. It is a legally recognized bankruptcy-proof bridge. It's a solid structure connecting all the safety and investor protections of traditional stocks with all the speed and access of modern blockchains.
Okay. I know this all sounds a bit like financial plumbing, but why should you, as an investor, or even just a curious observer, actually care about what kind of bridge gets built here? Well, it turns out the implications are absolutely massive. To give you some perspective, the entire market for all tokenized assets today is around $25 billion. And yeah, that sounds like a lot of money. But in the grand scheme of finance, which is measured in the tens of trillions, it's a tiny drop in the ocean. The room for this to grow, if we get it right, is almost impossible to imagine. And here's what that growth really means for all of us. It means a future where you can have true ownership of a digital asset, with all the rights that come with it. It could finally unlock access to things that have been off limits, like investing in private companies. For anyone in the crowdfunding space, this could finally solve the massive liquidity problem. And yes, it makes all of this possible on secure markets that run 24/7. This is way more than a technical upgrade, it's a real shot at democratizing ownership.
So, as we wrap this up, let's just end on this thought. The race is on. That bridge between the old world of finance and the new digital one is being built as we speak. The only question now is which blueprint is going to win. Are we going to build a solid, trusted structure based on models that we know work, or are we going to settle for something less? The answer to that question is going to shape the future of investing for all of us.